Everyone wants the next NVIDIA. They want that clean up and to the right chart, a stock they can ride for the next decade and brag about at dinner parties. But that's not how it works. You want the next NVIDIA, you've got to catch it before it looks like NVIDIA. And that means you're going to have to sit through some pain. Today, we're talking about CoreWeave, the so-called AI cloud disruptor that just dropped 34% since earnings and another 15.5% this week alone. People are panicking. Reddit's melting. The chart looks like it fell off a cliff. Everyone's screaming that the stock is done. But here's the thing. The numbers in this earnings report say something completely different. Massive growth, billions in backlog, record deployment of next-gen GPUs, and yet the stock is getting obliterated. So what's going on? Is this a broken stock or a misunderstood business? Because if the thesis is still intact, this is exactly when you want to pay attention. Let's get into it. CoreWeave tripled revenue. That's not a typo. $1.2 billion this quarter, up 207% year over year. And the stock down 34% since earnings, down another 15% just this week. Let me save you the confusion. Wall Street doesn't care that revenue tripled, not if margins died to make it happen. Their operating margin didn't slip, it collapsed from 20% a year ago to just 2% now. And that 2%, it's GAAP. Once you back out interest and stock compensation, you've got a $290 million loss and a company bleeding cash to stay relevant. This isn't growth. This is expensive scale. It's one thing to sprint when your knees are strong. It's another when they're buckling under the weight of $3 billion a quarter in capital expenditures. You don't get rewarded for speed if you can't land the plane. So why did the stock crash? Because the smart money saw the cost of that growth and realized this isn't sustainable unless something changes. Either margins go up, capital expenditure comes down, or the backlog starts converting faster than expected. Until then, you're betting on a company racing at full speed while the engine's on fire. Let me give you a number that should have sent this stock to the moon. $30 billion. That's CoreWeave's backlog. Signed contracts, multi-year commitments, locked-in revenue. This isn't some pie-in-the-sky forecast. These are real deals with names like OpenAI, Microsoft, and a brand new hyperscaler nobody's naming yet. But the market didn't care. Why? Because backlog only matters if you can deliver it. Right now, CoreWeave is throwing $3 billion per quarter into capital expenditures just to keep up with those commitments. If that expansion hits a snag, power delays, supply chain choke, financing costs, the backlog becomes a liability, not an asset. Investors aren't stupid. They see the number, but they also see the time it takes to recognize that revenue. A 36-month contract doesn't pay the bills today, especially not when you're burning cash like a Vegas gambler. Here's the deeper truth. Backlog is potential, not profit, and CoreWeave hasn't proven they can convert it with margin. Not yet. So yes, $30 billion sounds impressive, but unless that turns into cash with margin and scale, it's just a number. You don't get paid on backlog, you get paid on execution. Forget the revenue, forget the backlog. Here's what actually triggered the sell-off. CoreWeave posted a $131 million adjusted net loss. That's after backing out stock-based compensation and non-cash expenses. This isn't an accounting trick. This is a company that's losing real money, even on the metrics they chose to highlight. Here's the problem. They're spending billions to scale, but that scale isn't profitable and it's not getting more efficient quarter to quarter. In fact, it's getting worse. Margins are compressing, costs are exploding, and their biggest lever, depreciation, might be built on bad assumptions. They're running straight-line depreciation on GPUs over 6 years. That's fantasy. These machines won't be competitive in 3, maybe 2. That means the numbers they're showing today are masking deeper economic losses underneath. Interest expense was $267 million this quarter alone. If you adjust for realistic depreciation and front-load the GPU cycle, they're losing money fast. And that's with the benefit of some of the best AI contracts in the industry. This is what Wall Street's reacting to. Not the headline numbers, the mechanics under the hood. This is a capital-intensive business with thin margins, rising rates, and an execution burden that most companies would buckle under. And right now, the clock is ticking. CoreWeave's edge was simple. They got to the GPUs first. Period. While everyone else was waiting on NVIDIA supply, CoreWeave was already deploying H100s at scale. That's how they landed Microsoft. That's how they beat AWS to market. But that edge, it's over. Now everyone's buying Blackwells. Microsoft, Oracle, Meta, they've all caught up. The hardware gap is closed, and CoreWeave doesn't control the chips. NVIDIA does. So what's left? They just bought weights and biases. It's smart. It gives them software visibility, maybe some stickiness. But let's be honest, it's not a moat. Not yet. Most customers can still leave, and if your biggest advantage is renting out the same GPUs as your competition, you don't have an advantage. You have a temporary lead in a commodity business. That means one thing, a price war. And if margins are already thin now, imagine what happens when AWS undercuts you just to gain share. This is the part no one wants to say out loud. If CoreWeave can't lock in customers with something other than hardware, this entire business model becomes a race to the bottom. Speed got them here, but if they don't build defensibility, they're gone. CoreWeave is trying to buy Core Scientific in a $9 billion all-stock deal. On paper, it makes sense. Core Scientific gives them access to 1.3 gigawatts of power infrastructure, exactly what CoreWeave needs to expand compute capacity and fulfill that $30 billion backlog. But here's the problem. The deal's in trouble. Core Scientific's largest shareholder is vowing to vote it down. They're calling the deal inadequate. And if it fails, CoreWeave doesn't just lose an acquisition, they lose the single most important asset for scale in this business, power. No power means no expansion. No expansion means no delivery. And no delivery, that backlog investors keep clinging to, it doesn't get recognized. Even worse, this is an all-stock deal. That means dilution. So if the deal goes through, CoreWeave shareholders are giving up a massive chunk of the company just to plug a hole they can't fill internally. This is the bind they're in. Without Core Scientific, they fall behind on capacity. With it, they dilute and add complexity. So the market's asking, are they solving a problem or creating a bigger one? Because if this deal breaks down, the bull case gets a lot harder to defend. Let's stop guessing and look at the real picture. Is CoreWeave a good long-term investment? That depends entirely on one thing. Can they turn explosive growth into sustainable, profitable scale? Here's the bull case. Demand for AI compute is not slowing down. CoreWeave has locked in over $30 billion in signed contracts with top-tier names like Microsoft and OpenAI. They're deploying NVIDIA's newest chips ahead of most competitors and scaling infrastructure faster than any AI cloud startup we've seen. They've got speed, they've got momentum, and now with the weights and biases acquisition, they're starting to build a software layer that could create real customer lock-in. If they execute, they'll become the backbone for AI developers who don't want to be tied to the big three hyperscalers. That's a serious runway, but here's the bear case. They don't have a moat yet. The hardware advantage is fading. Software is promising but unproven. Power access depends on a deal that may not go through. Margins are shrinking, capital expenditures is massive, and right now they're losing money fast. This isn't a steady compounder. It's a high-stakes infrastructure bet in the middle of a land grab. So let's be clear, this isn't a safe investment, but that doesn't make it a bad one. This is a calculated risk, and like any high upside play, it all comes down to execution, which is why I'm watching closely, because when the numbers line up, I'll be ready to move. Let me guess, you saw the chart and thought, this thing's done. Down 34% since earnings, down another 15.5% this week. The trend is ugly. Lower highs, lower lows, and no support in sight. And the internet's already writing the obituary. Here's what I'm doing, nothing. Because I'm not trading the chart, I'm watching the business. Was I bullish after the last report? Yes. Am I still? Yes, but now with more clarity. Wall Street sold off the stock because they should have. Margins collapsed, losses ballooned. The growth came with real cost. That's not fear, that's discipline. But here's what didn't change. They locked in over $30 billion in signed deals. They're scaling faster than anyone else in the space, and demand for AI infrastructure is only getting stronger. If they fix margins, even slightly, the entire story flips. This doesn't become a recovery play. It becomes a category leader. I'm not trying to time the bottom. I'm not buying dips to feel clever. I'm watching execution. I'm watching cost control because when margins turn, this rips. And to be clear, this is a high-risk, high-reward setup. For most people, it should be a small speculative piece. only if you're willing to take a bet that could absolutely fail. But if they pull it off, the upside is massive. So no, I'm not panicking, I'm preparing, because when the numbers line up, I'll already know the story. So let me ask you something. Who else is breaking down AI infrastructure deals, margin pressure, and execution risk with this level of honesty, and still showing you how to position with discipline? Who else walks you through the bull and bear case, gives you the thesis, and shows you how to actually build wealth in public? Nobody. That's why I'm up over $2.2 million year to date with a 63.59% gain in 2025, and it's only August. But it's not just me. Queen of Me made over $5,500 in trades last month on NBIS, BNMR, Palantir, and Robinhood, all from moves we talk about inside my Patreon. LT Champ just executed their first ever call and put option and walked away with 88% gains. This isn't hype, this is execution. Inside my Patreon, you get real-time trade alerts with full breakdowns, entries, exits, and the why behind every move. Daily market analysis, focused only on what matters. My exact momentum strategy to scale into investments like CoreWeave when the setup is right. It's only $30 a month. People waste that on apps they forgot they're subscribed to. This is the one thing that could actually pay you back. If it doesn't make you sharper, more confident, and more profitable, cancel anytime. But if you've been watching my videos nodding along and telling yourself, I should join, then stop watching, start building, because the truth is simple. You can scroll or you can scale. But either way, don't say you weren't told.